Despite all the craziness that's been going on, we can't forget that Fannie Mae and Freddie Mac hold a great deal of influence over the housing market, and they've just made some temporary guideline changes. So, who does it affect and how is it going to affect them? Hey guys, Orbel here. So, in today's episode, I want to discuss who and what Fannie Mae and Freddie Mac are, along with the type of influence they hold over our housing market. But make sure to stick around until the end because I am going to discuss what these temporary guideline changes are. First and foremost, I want to give out a big thank you to everybody that's been watching and supporting the videos. I hope you guys are enjoying them. Secondly, I know that we're all still stuck at home, so hopefully you guys are staying in good spirits and staying positive, and I'm sure we will be back to normal soon. So, jumping into today's episode, I said I was going to discuss Fannie Mae and Freddie Mac along with who and what they are. Now, both Fannie Mae and Freddie Mac are considered to be GSEs. GSE just stands for Government-Sponsored Enterprises. And instead of me explaining it to you, Google has it worded best, so I'm just going to go off of what they have written over here. In the US, Government-Sponsored Enterprises, or GSEs, are quasi-governmental, privately held entities established to improve and at times make possible the flow of credit to specific sectors of the economy or to otherwise provide essential services to the public. GSEs are established by Congress. So with that said, it's no surprise that Fannie Mae and Freddie Mac would both be GSEs, given that Fannie Mae and Freddie Mac play such a big role in the housing market, and the housing market is such a big factor in the economy. The government would want some level of control over what's going on. Now, given that they have some control, it didn't really stop the 2008 housing problem that we had, which was the crisis. So with that said, the government's also created a new agency, which is called the FHFA, which stands for Federal Housing Finance Agency. And what they do is pretty much provide oversight and regulation over Fannie Mae and Freddie Mac to make sure that nothing like 2008 happens again, where requirements become loose and all sorts of loans are being originated. They're just there as essentially regulators over both Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac, what do they do and why is it that they play such an important role in the housing market? Fannie Mae and Freddie Mac provide liquidity to banks for banks to continue originating loans. And what I mean by that is that whenever a bank or a non-bank lender originates a loan, they sell their loan to Fannie Mae or Freddie Mac, and then Fannie Mae or Freddie Mac packages up a bunch of these similar loans, and then they sell it as securities to investors. So this does two things. One, it allows investors to get what they want, which is to purchase an investment which comes from a credible source such as Fannie Mae or Freddie Mac, which they know is being governed by FHFA, which is giving more credibility to them. And at the same time, it's allowing banks to receive money in their hands in order for them to continue providing more home loans and to keep this housing machine to move forward. So, with that said, what are these temporary guideline changes that Fannie Mae and Freddie Mac have made? Now, they've actually made a ton of temporary changes, but the two that I'm going to mention are the ones that I think you guys should really keep in mind and the ones that, to a certain level, you're going to have some control over. Now, before I actually mention these two points, I do want to mention that Fannie Mae and Freddie Mac are always making guideline updates. As times change and as time moves forward, there's always new guidelines that come into play. The only difference is that this time around, this coronavirus, the COVID-19, had made such a quick impact almost overnight that they had to act quickly and put some things in place to protect everybody, including home buyers. So what are these two adjustments and two temporary guidelines that they have? Let me read it off the website here. So the first guideline update I want to talk about is the reserves requirement. So anytime you want to apply for a home loan, they're going to want to see some sort of a reserves account that has money put aside for a certain amount of months that can make a mortgage payment just in case if you have a rainy day. Now, usually they allow people to show stock accounts or stock options or mutual funds. And they still are allowing that, but now the only difference is that they're allowing only up to 70% of what's in those accounts. So if in the past, let's say you had $10,000 in a stock option or in a mutual funds or just in general in your in stocks, what you could have done was that you could have just showed all $10,000 of it and said, hey, I have this money sitting here and I want to use this to satisfy that requirement that you guys have. But now they're only gonna consider 70% of what you have in that fund, in that account. So if you had 10,000, they're gonna look at it and they're gonna say, we're gonna pretend like you only have 7,000. Now, if that 7,000 is all you needed to satisfy that reserves requirement, then you're okay. But obviously, if your reserves requirement is much more, then obviously you're gonna have to figure out something else, whether it's showing an additional checking account or a savings account. They're going to want to see that. And the reason that they're doing this is because there's been a lot of volatility in the market. So obviously if they take everything at face value, we don't know what's going to happen tomorrow. There's been a lot of movements. So that's just for the reserves. I don't think that's a huge deal, but it's something to keep in mind, just in case if you're planning on using solely your stock account or something to that extent to show that you had money tucked away. So the second requirement that they've had a temporary update to is the self-employment verification. And this is the one that I think is most important because there are so many people that are self-employed and this may affect them. Now, given that whether you're a wage earner or self-employed, a lot of jobs have been affected with COVID-19 being around, but there's a lot more pressure on self-employed people because if somebody who works for a company, if the company's not doing good, they may still have their hours and they may still be getting paid the same way, but somebody who's self-employed and they may have a small business, their income may directly be impacted and immediately be impacted. So usually what they do is they take some sort of a CPA letter, or they may call the place of business just to make sure that it's operating and it's good. But because of what's been going on, they want to take it one notch up, and they want to really make sure that on the day they're calling, that on that specific day, the business is open and it's still operational. So on Fannie Mae and Freddie Mac's website, they have three main things that I've noticed that they've listed, which could be ways that allow the lender to check if the business is operational. So they may just call the business and see if it's open and see if that hour matches what's on Google. If Google says that they should be open at 5 p.m. and they call at 5 p.m. and it happens to be closed, then there may be some sort of a problem since there's a discrepancy, and they may say the business might be impacted since they're not open. Another method is that they may just ask for the business owner to provide invoices or sign contracts on the day of the verification to prove that on that specific day they were still operating and that they were in business. The third method is if the business uses a website to operate their business, then they're going to want to see some sort of proof that they're either taking appointments or they're fulfilling orders. Anything to that extent, they're going to use the website to make sure that they could verify that you're pretty much still in business. Now, it's important to mention that Fannie Mae or Freddie Mac is not the one that calls and verifies this information. It's actually the bank, because it's required of the bank to do this stuff if they're planning on selling the loan to Fannie Mae or Freddie Mac. So with that said, what does this mean for the future of lending, or at least for the current state of home loan applications? Well, during this current time, they're obviously going to go by these methods, and they're going to be a little more careful than usual, just given that there's a lot more market volatility and that a lot of businesses are closing. So these are necessary steps that they're going to take at least until probably end of May. But you never know. If things get worse and we're still in quarantine for much longer, then this will probably continue to stay how it is with these temporary requirements. They may just extend. But in the meantime, if there's any questions, feel free to send me a message and we could go over your specific scenario and see if there's any problems we could foresee. And aside from that, thank you so much, guys, for joining in, and I'll see you guys next week.